We're on day 4 here of Options Education Week at thesteadytrader.com, and today I'd like to talk about implied volatility. This is a topic and a part of analysis that is quite often overlooked by people using options, even if they've been using them for some time. It is easy to get caught up in the excitement of a stock going up or down and then simply buying a call or a put option. However, oftentimes implied volatility might not be at a point where it is advantageous to do such a directional trade. Now, first of all, what is implied volatility? Implied volatility is essentially the price that traders are pricing in to an option in terms of its expected volatility going forward. So if traders are expecting a stock, for example, to be highly volatile going forward, the implied volatility is higher, meaning which also makes the call option more expensive. Vice versa, if traders think that a certain stock is going to not do a whole lot going forward, maybe consolidate, then the implied volatility, meaning their forward expectation of volatility, tends to be lower, thus making, let's say, a call option cheaper on that particular stock. So I have a chart here that I'd like to share with you that is essentially a two-pane chart. At the top, it's just a price. This happens to be the share price of Procter & Gamble. It really doesn't matter what the stock is. And at the bottom is the implied volatility. So this is over the course of time, how expensive the options were for this particular stock. And you can see there is some sort of a mean, an average, right? Which if I were to just draw a very simple horizontal line, looks a little bit like this. So the average volatility over the course of this time for this stock was probably somewhere around 20. But as you can see, there were times when this stock had a volatility almost near 40, and at times when it was closer to, maybe 10, which was very cheap. So in general, if I'm going to get excited about a stock's upside potential and the implied volatility is at least somewhere around the midpoint, I personally would be okay buying an outright call. If the implied volatility is above the average of the period I'm looking at, and certainly if it's very high, I would be much less inclined. In fact, I would not just buy a call option if my excitement is that the stock would go higher. I would at the very least buy a call spread, whereby I buy a call and then sell another call against it to make it a bit cheaper, or be a seller of options. Likewise, if the implied volatility is very low, if I'm looking to buy a call, if that's my thesis, that certainly would be where I'd be quite happy to buy a call option, because not only can I make money if the stock goes up, but also if it is increasingly perceived that the stock might go up, and implied volatility does go up, then of course I can make money that way as well. So moral of the story, buy low, sell high. That does not only apply to the actual stock price, but also to implied volatility when it comes to options. If this video helped you, please make sure you subscribe to the channel, you give us a thumbs up like, and if you want to see this approach in action, you will want to join us in our Set the Market morning call, which happens at 9 o'clock Eastern Time, Monday through Thursday. Make sure you join us for that in the link down below. Again, subscribe to the channel. I'll see you in the next video.